Dear investor, I am addressing you for the first time from my new platform. Joined this place, Motilal Oswal, from 3rd of October this year. In this edition of Monthly Update, we will focus on the debates that I encounter in the marketplace. That being how are Indian valuations versus that of the globe versus that of other emerging markets, and whether these are sustainable. This has happened because India has been one of the better performing markets globally, and this has resulted in a sharp up move in its weight in the global indices. The valuations are significantly higher than historical valuations relative to emerging market peers, which is what is giving rise to the debate. We believe that this is sustainable. Sustainable meaning in spite of the relative outperformance, our valuations should sustain on our own context because of the following reasons. One, in this period of global turmoil, India finds itself relatively better positioned. This is primarily on account of our large forex reserves and low short-term debt. So, our short-term debt, if we compare it with larger economies, is one of the lowest. And if you look at our reserves, they would take care of 5 odd years of current account deficit. So that is, I think, substantially large, gives a lot of comfort to policymakers, and allows our country to continue to have business as usual kind of conditions. Many of our competitors, emerging markets like Pakistan, Bangladesh, Sri Lanka, and many others are not in the same position. They have had to seek help from multilateral agencies to tide over the current difficult times and are rolling out austerity measures. So this is something which differentiates us versus others. Second, the world is divided between commodity producers, commodity consumers, and when commodity prices were moving up, particularly oil, we had suffered, our markets had declined. But happily, over the last period, we have seen commodity prices decline. It is across the board, except for oil, which is still up on a year-on-year basis. Prices of most other commodities are now lower on a one-year basis, giving some amount of margin uptick to a lot of companies with pricing power, and also reducing the stress, hopefully going forward, on the forex. Forex is something that, as we said before, is very important in the current context of times. Third, while the world is talking of a slowdown, there are spaces in India, Indian economy, where the growth is accelerating or at least sustaining. This is important because earnings growth is the key driver of valuations. Take financials, the lenders, banks were witnessing just about 7-8% kind of credit growth. Now, as we speak, the credit growth that the industry is seeing is now gone up to mid-teens, and the better banks are doing better. With low NPAs, books having been cleaned up over the past few years, this is a space which is benefiting from the environment. Second space is chemicals, where the country is benefiting from China plus one sentiment. India is probably one other space which offers the ecosystem which is necessary for chemical companies to flourish, and the space continues to see very, very strong growth. Company after company is announcing large capex. It's not only China that is seeing some move away to India, maybe because of the higher fuel cost related issues. Some bit of business may come to this space from Europe as well. Third, defense. I mean, this is a space where import substitution is the theme. Geopolitical situation is not normalizing. The focus on domestic production is now the focus, and this should continue going forward. Engineering is another space which would benefit. There is a revival in domestic capex. Engineering companies have a better outlook, and once again in this space there can be some shift in global supply chains from Europe because of lower energy availability out there. Software services, this is a large space, apart from banks, account from a very large part of the profit pool. Now, this space tends to benefit from rupee depreciation, which we have witnessed, and to even on sales, contrary to expectations, most IT companies are seeing growth sustaining and have given out guidances, from whosoever has delivered results by now, for a good positive outlook into financial 33 and hopefully in financial 24 as well. Next, relatively stronger economic growth should sustain in India because our capex cycle has also just started. Now, this is a cyclical thing. It so happens that when there is a global slowdown, the capex cycle in India in many ways is starting. House building activity is improving. Government continues to focus on capex. That number continues to go up year after year. And corporate capex, which was not improving, has started to improve, assisted by production-linked incentives, which the government has rolled out. Healthy balance sheets of large corporates with low debt to equity and improved capacity utilization has improved the business confidence, catalyzing the shift in mind, and corporate capex is moving up. With this, a combination of several of these factors should result in growth sustaining in spite of some amount of normalization which may happen as the pent-up demand post-COVID becomes normalized. I think consensus also says that Indian economic growth should sustain at a high level even in financial 24. And this again, differentiates us versus others. Large economies in Europe and America suffer from either lower availability of energy, such as in Europe, or higher interest rates, which are impacting the growth outlook for the economy, as in the US. Leaving India as one beacon of hope for growth investors. Now, the next point is interesting. While all of this is happening, we as a country are also seeing coming of age of the domestic retail investor. Retail investor has come to age. It is coming into the market in a structural manner for the medium to long term, rather than treating equities as a very, very short period investment. This has helped counter or lower the impact of FPI selling. In periods when FPI selling subsides, domestic buying continues. We have seen the markets become more buoyant, and in periods when both the large classes of investors turn buyers, markets are reasonably strong. I think the money flow into of retail into the market should continue for a long while of course not linearly, given the low starting percentage which is allocated to equities in the overall household savings space. Lastly, on this count, we are a growth country. Growth benefits if interest rates are lower. We as an economy, we as a market did get hurt when global interest rates moved up in response to higher commodity prices, maybe in response to geopolitics which is happening in the Russia-Ukraine space. The move up in interest rates, at least in the West, is unprecedented. It is causing stress there. Increasingly, we are getting thoughts of at least doing it slowly, and otherwise, the threat is that it can result in some market disruption. So this is something that one should be watchful of. I think as the policymakers call it a day in terms of tightening, in terms of increase in interest rates, and this could happen given the lower commodity prices which we spoke about earlier, while the inflation data continues to be higher. And inflation data is backward looking. I think going forward, inflation should come down, helping policymakers, take to do it more slowly rather than keep pushing for higher rates and lower liquidity. The combination of factors that we spoke about is not present in most other countries, and hence enable India to sustain the premium in valuations over them. It can change in future. That is something we are aware about. Things may get more normal for other countries, but then what will happen, to my mind, is relative to us, those markets may function better. It does not mean that our markets need to suffer a cut at that point in time. Especially when, if you look at valuations, valuations in the Indian context are sustainable. So we are off our highs by over 5%, recent highs by over 5% on account of slowdown in earnings and continued monetary tightening. Expectations on earnings growth have come down, and on new expectations, the current market implies a PE of just about 18.5 times, which we believe is fair given that it is last 5 and 10 year kind of average. Longer period averages have less relevance because over time the index composition has changed and percentage of higher PE stocks in the index has risen sharply. However, given the fact that bond yields have moved up, in comparison to bond yields, earnings yield look less attractive, and that makes us believe that we could see a period of consolidation in the Indian market. If inflation reduces, if interest rates reduce, that could act as a fillip provider to the market. But otherwise, let's expect market to consolidate in a narrow range for the immediate future. With the breadth of the earnings being good, it should continue to be a stock pickers market. On that count, let's come down to the quarterly result expectations for Q2 financial 23. The season is on. The numbers that we have seen by now are more or less in line. This is a season wherein after a long while we are expecting a YOY decline in profits. However, most of the decline is driven by commodity names. The users of commodities should actually show a pretty sharp uptick. Banks and autos would lead the uptake. Few results which have been declared have been mostly in line, and the good thing is that the market has responded positively. IT companies, once again I come here, have delivered better numbers than expected in many cases, which is credible in the face of global slowdown, and the commentary has been reasonably strong. Cement companies have disappointed. Coming down to my next topic, which is alpha generation. This is again something which is talk of the town, whether the capability of Indian managers to generate alpha is reducing. I think going forward, once again, the Indian markets will permit larger alpha generation versus what has been the case over the past few years. Now, there are a few factors aiding this. One, the earnings breadth is increasing. Markets are slaves of earnings over the past several years, 2007 to 2019-20 kind of a period. Earnings momentum was displayed by a narrow set of stocks, and this resulted in a sharp polarization in the market. When earnings growth came back, they came back to the larger stocks first, larger businesses first, and that was the part which did well. It is only now that the earnings growth is spreading to a wider canvas of stocks. As that happens, risk taking by active managers becomes more rewarding and alpha generation possibilities emerge. Second, heightened risk perceptions on the macro side are normalizing. COVID period of Russia-Ukraine, period of sharp oil price increases were periods where once again, market breadth narrowed down, risk taking reduced. Now, as these things are normalizing, it should again result in better market breadth. Third and very important thing is broadening of market participants themselves. There was a period when markets were driven by FPIs, and a lot of that money was ETF, close to the index kind of positioning. Even Indian money was structural, but came close to the index in the form of EPF and pension flows. So while the index and close to the index names did relatively better, the broad market did not. Now it is not only that the breadth of the earnings is increasing, but because of strong comeback by domestic retail and HNI market participants, the number of stocks which are participating in the up move is higher. We believe this is a structural trend, given that the allocation to equities is low in India and the breadth of market should sustain, which again improves the alpha opportunities for managers. And of course, not to forget the continued strong pro-industry, pro-job creation, pro-domestic capability development focused, let me say government reform momentum that also provides a very, very positive impetus. All of this I do believe should help Indian managers generate alpha going forward. In the end, let me talk about our positioning. Okay, here let me point out that over the past few years, the market performance of high quality businesses delivering sustained growth was significantly in excess of earnings growth demonstrated. This made the space very expensive. We have tried to showcase it. For example, the consumer space delivered lower EPS compounding versus the technology space, but has seen a market cap compounding of 3% in excess of profit compounding, not for 1 or 2 years, but for a period of 15 years. The experience with the technology space has been very different. It has seen compounding a percent lower. This has resulted in starkly different valuation outcomes for similar quality, as measured by ROC kind of businesses. Our house is hence now focused on spaces which have participated to a lesser extent in price compounding while offering high quality character. We believe this is a space that offers much better risk reward equation. Please don't go by the example. Example was just to make the point across, put the point across. But that will help you understand how we are positioned in the quality space, but with a very, very keen eye on valuations. This is what we believe will deliver good preservation of capital for our investors while also ensuring growth. With that, thank you, happy investing and happy festivities.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.